By January 4th today, these people will have already made the same amount that the average Canadian worker will make in all of 2023. So is something broken? Well, this is something that certain politicians believe, especially given the report that was just released that revealed that at the very same time average Canadians have taken a 2% pay cut when adjusted for inflation, the top 100 CEOs in the country, well, they've taken a 26% pay increase when accounting for inflation. But by using advanced tax strategies and non-money payment options, the report claims that these individuals are largely able to avoid paying tax on a large portion of their income. So let me show you this report, and we're going to talk about what loopholes are being used here and if you can apply any of these concepts to your own income situation, and how the government might get involved in a way that could actually end up hurting average Canadians who are trying to increase their financial sustainability and grow their own wealth. So let's get right into the information, and something new for people who are subscribed to this channel. If you check out the first link in the description, there is an email sign up there, and I'll be sending out more detailed analysis on all of this, along with all of the links and sources for these videos. So if you want to catch up, make sure you drop your email into that first link underneath the video description. This new report takes a close look at the earnings of the top 100 CEOs in Canada and how that compares to the average earner in Canada. And you can see from this first graph what the average pay is for these top 100 best paid CEOs in Canada, sitting right around $14 million as of the year 2021, where this data was brought from. If we take that pay and divide it by the average amount of working days in a year, that's 250, you can see that per working day, these folks are making $56,000. And if we consider a 12-hour work day, well, every single hour they're making $4,666. When we take this $56,000 per day that these top 100 CEOs are making and compare it to the yearly wages for Canadians, well, you can see the stark difference. The median wage for Canadians was around $40,000 and the average was around $58,000. Median is a little bit different from average. Average, the higher numbers can sort of pull the average up, whereas median is just like if you lined up every single Canadian income earner and asked the guy in the middle how much they're making, that would be the answer, $40,000. But either way, you can see that essentially in a day, these top 100 CEOs are making the same amount that people make in an entire year. And this has some politicians, well, simply put, pissed off, especially the NDP, with Jagmeet Singh holding this press conference this morning.
And neither the Liberals or the Conservatives are willing to point this out. What we are saying very clearly, and the evidence shows this, that corporate greed is causing the pain that people are feeling. It's one of the elements that's contributing to the pain that people are experiencing. Corporate greed is contributing to the cost of living going up, and we need to tackle it. While the Prime Minister says it's too simplistic to make CEOs pay what they owe, we disagree. We think the Prime Minister is wrong. It is the right thing to do to make CEOs pay what they owe. And if they're not paying what they owe, then people end up paying then the price ends up falling on the shoulders of people.
But what matters most is what the current Liberal government thinks about all of this. You heard Jagmeet Singh there referencing Justin Trudeau saying that that Singh's ideas were too simplistic, and that refers to this interview that Justin Trudeau gave to the CBC at the end of 2022.
Your government has implemented a windfall tax on sectors like banking and insurance sectors. The NDP says, what about oil and gas and grocery sectors? Have you considered that? Is that something you would consider?
We're always looking at ways of making sure that everyone's paying their fair share. One of the things we're very much trying to do with the oil and gas sector, recognizing their extraordinary profits over the past year because of high oil prices, making sure they're investing in decarbonization, because these are investments they need to be making to ensure that there are good jobs in the energy sector for Canada for decades to come. So that's very much how we're encouraging and constraining them to try and be reinvesting.
What about grocery stores, though, that continue to make a profit at a time when, for a lot of Canadians, that doesn't seem right?
The last thing we want to do is put on a tax that people then just pass along to the consumers. So we have to be careful about what we're doing. We're studying. I know there's been a lot of studies on what's happening with food prices, and we're looking at trying to help people. That's what we've tried to do every step of the way. But I don't think that the simplistic solution, as satisfying as it might sound, is necessarily the right approach here.
They mention a potential windfall tax and maybe even a wealth tax, and we'll get back to that in just a moment. But a key takeaway from this report that we've started looking at is that these high income earners earning around $14 million in total income are able to use some creative workarounds to not show that full $14 million, actually showing that their salary, even though their total income is $14 million, their salary only shows at $1.1 million, resulting in less tax being paid than you might expect. Let me explain. Here we can see the income breakdown for some of these top CEOs, and you'll be surprised to see that the base salary is only 8% of their total compensation. This is the salary that the company pays them year in, year out as part of their contract. The things that really bring up their income are shares, stock options, and bonuses. Now, bonuses are just cash bonuses, hitting a target and you get paid that amount. That is taxed as normal income. Same goes for shares. If you receive shares as payment, that is taxed. You're taxed at the value of those shares when you receive those shares. So that's also taxed as normal income. But where there's a little bit of funny business and a little bit of loophole squirming is inside of this stock options section of the salary for these top 100 CEOs. When employees are paid in stock options, they're not given the stock in the company directly. Instead, they're given the option to receive that stock at a later date, which they can then choose to use or to exercise in the future. That's where a little bit of the loophole funny business starts to come into play, and it's found in paragraph 110, section number 1D inside of the Canadian Income Tax Act. If the employee who's receiving stock options fits a number of different criteria, then they're able to essentially disqualify half of their stock option pay from being taxable at all. So if we take the example of the person getting paid $14 million as a CEO and getting paid 26% of that in stock options, those stock options are worth $3.78 million, but they're not actually deemed as owning those stocks until those options are exercised. And if they use this loophole 110(1)(d), then they're only taxed on $1.89 million of the $3.78 million in value that they received as their compensation. And that means that on that $1.89 million, they would pay $1 million in tax roughly instead of $2 million in tax, saving $1 million in tax obligations here. So taking into consideration this stock option loophole and all the other ways that CEOs are paid outside of money, on that $14 million of income for the average top 100 CEO, they would pay roughly $5.7 million in tax, or 41% of the $14 million. I'm curious, and let me know down in the comments, do you think that 41% of a $14 million income is enough for the government to take? Well, this report certainly doesn't think so, and they propose some other solutions for this, one of which I think has a positive intent, but I think that it actually has a negative consequence if this change were to be made for average Canadians, slowing down the amount that they can invest and save. Their first of four solutions is to limit corporate deductibility of compensation over $1 million. Sounds complex, it really isn't. When businesses pay employees, that's an expense for the business, and they sort of subtract that from the money that they make so that they don't have to pay as much tax because they had to spend that money to make the money that they made. However, I think if they were to put this onto these top 100 CEOs, it might not have as large an impact as they might hope, because this is talking again about salaries and wages of over $1 million, when we've just sort of seen that, well, largely these CEOs are only making around $1 million in real wages or salary, and the vast majority is in stock options and stock bonuses. Now, this is the one that I have some concerns about. They talk about raising the capital gains inclusion rate to 100%. We've talked about capital gains on the channel before, but essentially if you buy an investment and it's not in like a certain special investment account, when you sell that investment for more down the road, then the government comes and says, hey, I want a piece of your investment, and they will tax you at your income tax rate on 50% of the growth of that. So if you bought a stock for $100 and sold it for $200, the Canadian government would say, okay, we're going to add $50 to your taxes this year, and you have to pay tax on that $50 of growth that you got from investing. Now, the reason they say they want to increase the capital gains tax to cover 100% of that investment growth is because so many CEOs get paid in stock, and maybe that stock isn't worth as much when they begin working there, and then as the company grows and the stock grows in value, well, when they go to sell that stock, they're only paying income tax on 50% of the growth of those shares. So they're saying, okay, well, most workers aren't paid in stocks and only wealthy people are paid in stocks, so maybe we should increase that capital gains inclusion rate to make sure we're capturing as much money from these wealthy people as possible. While it could make sense for the government to take a larger part of the pie for wealthy people who are making money from their investments, I hope that this rule wouldn't apply to Canadians who are maybe not as wealthy and are not wanting to give the government some of their money that they risked in their investment to grow. Now, of course, investing inside of a TFSA can largely eliminate this issue, but that TFSA really only has a limited amount that you can contribute to it when you're investing, but we'll get into that in just a minute. The report also suggests that we increase the higher top marginal brackets. Right now, if you're making over $250,000 in Ontario, you're taxed around 53%, and they're suggesting that we should go back to the way that it was in the 1950s and 1960s, where that top range was around 70 to 80% for the top income earners. And their fourth solution here is introducing a wealth tax for people over a certain net worth, saying up to 3% of that wealth will be taxed year in, year out. Remember, all of these taxes go directly to the government, and the argument of this report and those that advocate for higher taxes in general is that the government would be able to use those dollars to pay for important social services and expand social supports. But one thing that I always question personally is how effective the government is at using these funds. Increases in taxes only have an impact if you believe the government will appropriately use the funds to positively impact society at large, and that's something that fewer and fewer people actually have faith in. Now, this report was put together by the Canadian Centre for Policy Alternatives, and when we take a look at where the funding for the Canada Centre for Policy Alternatives comes from, who gives money to this organization, well, you can sort of start to see their political leaning. This is a list of the donors of over $15,000 in the year 2016, and you might notice a common thread here. Almost every single donor and funder is a big labor union: BC Government and Service Employees Union, Canada Labour Congress, Canada Union of Public Employees, Health Sciences Association of BC, Manitoba Government Employees Union, unions, and of course unions is rather left-leaning, and the NDP is often gets support from these unions, so you can kind of see where the incentives lie, at least looking at this. But that's not to discredit the findings of the report. I think it's actually really interesting to look at, and I don't think that you can really blame the people for using these fully legal parts of the Canadian tax code to reduce the money that they're paying to the government. You can blame the government, however, for allowing these loopholes to exist, but I don't personally blame the individuals for using the rules as they are today. And I think it provides an opportunity for us to think about how we can reduce our overall taxable income and our tax obligations. I'm not a CPA, and this isn't advice or a representation of my own tax planning, but many people consider starting side hustles and businesses so that they can begin to write off more and more expenses that you wouldn't have otherwise been able to write off if you didn't have this side business. And of course, you should always be taking advantage of the special tax saving investment accounts that can help you reduce your tax obligations as well. The first one that might come to mind is the tax-free savings account, where you can grow investments inside of there and not have to pay capital gains tax when you sell at the end, or also the RRSP, a fund that you can contribute to on a yearly basis to reduce your income and as a result reduce the amount of taxes that you owe the government. And I'm curious what you think about all of this. Do you think this report is right on the money, or does it skew in a way that you don't agree with? Let me know down in the comments. I read every single one and I try to get back to a bunch of them. And a brand new thing for the channel, the first thing in the description below is an email list for the channel. If you're curious about any of these sources, where I got these numbers, all of these different reports, I'm going to be sending out weekly at the end of the week a list of all of the sources and links that I've used in my videos throughout the week. So if you want to take a closer look and get additional analysis, then you can sign up for that email list right there in the description. I'd appreciate you doing that. But with all of that said, thanks so much for watching, everybody. I really hope this video helped you out at least a little bit, and I'll see you next time.